Great. Okay, welcome everyone to Bruegel for our event on the economic case for decarbonisation of emerging and developing market economies, and particularly on the economic case for rich countries' support for this decarbonisation. So it's a very propitious moment at the end of COP. We are not on track for reaching the Paris temperature goals. Time is narrowing, carbon budgets are running out. Now here at Bruegel we have done a lot on energy and climate economics over the years. For the most part this work has focused on the decarbonisation of the EU and more broadly on advanced countries. What is increasingly clear is that if the EU will succeed in really increasing the chances that the Paris Agreement meets its aim, it has to focus much more on climate policy outside the EU. And so this event is supposed to generate some thought in this direction. So we have 4 fantastic speakers. With me in the room is Elissa Klein-Nijenhuis, who is a non-resident fellow at Bruegel, and she also teaches at Cornell and is a researcher at Imperial College in London. And she joined us yesterday from London in person. Online we have Abhishek Bashkar, who is the lead in the Accelerating Co-Transition Investment Program of the Climate Investment Funds. We have Linda Fitz, Director for Sustainable Infrastructure of the US Department of the Treasury. And last not least, we have Li Kao, who is the Vice President of the Bois Forum for Asia. So welcome very much. We have an audience in the room, which right now the online folks cannot see. You will, I guess, see them later. Unfortunately, it's not quite as numerous as usual because we have a national transport strike in Belgium and Brussels today. The metros are closed, so it's really hard to get here. And so I congratulate those that are here for making it nonetheless. I guess it shows that Brussels is a walkable city. So the choreography is going to be, I will ask Elissa to start with a presentation of her work. So this also refers some ongoing joint work, but it's mainly her work on the topic. She will take about 15 minutes. And then we will ask each of the panelists to give their contributions for maybe about 8 minutes, and then we'll have a Q&A. And of course, the online audience, as always, can ask questions on Slido, and the Slido code is #emissions. Okay, Elissa, floor is yours. It's coming, I think.
And I'll talk about how the idea of climate finance at scale has been brought into practice at a smaller scale so far in the form of just energy transition partnerships. And then I'll talk about some of the public finance challenges both for the financier countries and the recipient countries, and then I'll conclude. So we live in a world where the emission concentration has been steadily rising. Here we see the measurements by NASA made since 1958, and they have risen from underneath 320 parts per million to around 419 parts per million today. And for those of you who think that it's normal, it's not. What we are witnessing today is that we are completely off the chart. And Al Gore, once showed this chart, and he used a lift to get all the way to where we are today, just to show how off we are compared to the geological long-time records. And not only the emission concentration is rising, but also the annual emissions have been rising steadily, with the exception of 2020 COVID crisis, up to today. So the big question that we face today is, how do we bring emissions down to stay within the very limited carbon budget of perhaps 280 tons of CO2 that we have left, to try to make sure we don't overshoot temperature targets, ideally of 1.5 degrees of global warming compared to industrial levels, because the climate science is making increasingly clear that above 1.5 degrees we face very large risk of crossing climate tipping points that could completely disturb life on Earth. And actually there was just a report that came out by the Base of Earth Foundation and some famous authors like Tim Lenton, who is famous also for his planetary boundary report on this topic. So the question is, how do we stay ideally within 1.5 degrees? The climate policy making globally has revolved around some central tenets, some of which I believe certainly are not necessarily conducive to progress, and certainly we see that emissions have not budged yet, not even by 1 gigaton. So what are some of the flaws that we are seeing today? Up to today, global policymaking is still geared around global meetings to seek to strike a global agreement for a global externality problem. And so we've seen again now that everyone is gathering around the COP meeting of COP28. And the truth is that I don't think we will see a communique outcome that is nearly ambitious enough compared to the depth of the climate crisis. And of course the reason is that it will require unanimous agreement among all member countries, and you will then always get a watered down deal that is not ambitious enough. Another, perhaps problem with climate policy making is that it has been focused a lot, in absence of a global deal, on domestic decarbonisation. So you've seen the Inflation Reduction Act in the United States and the Green Deal in Europe. But we know that a lot of the emissions in the 21st century are projected to come from emerging and developing market economies. So there should be an economic case to help EMDEs decarbonize, to make sure that the world as a whole stays livable. And then another focus of climate policy making has been that the pursuit of carbon taxation at the social cost of carbon, but it has become clear that it's politically very hard to implement, and therefore up to today we still live in a world of incomplete carbon taxation, where perhaps only around 23% of greenhouse gases are taxed, and even those that are taxed way below the social cost of carbon. In addition to the first best so-called policy of carbon taxation, there have been incentives to generate climate finance for emerging and developing market economies, but the problem is it hasn't achieved scale. We're still falling short of 100 billion a year promised to emerging and developing market economies, even though it's clear that around trillions each year are needed. And in my view, the problem is that it's been framed as the equitable thing to do, whereas we all know that investors and also governments and individuals are driven by incentives, and financial incentives in particular. And the other drawback is that climate finance has focused on adding renewables to the mix without bringing offline fossil fuels. And we must bring fossil fuels offline, because they alone, even if we add renewables, are going to bomb us through the carbon budget. So what are some of the ways in which we can try to get around these drawbacks that have made it hard for us to make progress on bringing down the gigatons of CO2? So here we argue in this policy brief that in addition to carbon taxation, there's a complementary case for climate finance at scale. And here we try to lay out what that case is. We focus in the brief specifically on quantifying the benefits and costs, economic benefits and costs of phasing out coal, which is logical because it's the most polluting fossil fuel, and also is actually the single biggest source of emissions in 2022 and 2023. But in principle, the analysis that we do can be replicated for fossil fuels in general. So what have we done in this brief, which is based on a paper called The Great Carbon Arbitrage? We've asked a very simple question: how much would the world benefit from phasing out fossil fuels, coal in particular, and replacing it with renewables to a sufficient extent to not only replace it, but to keep up with growing energy demand? And so what we find is that the net benefit, which we here refer to as carbon arbitrage, because the risk of doing the phasing out of coal and the introduction of renewables is very small, is over the course of this century around 78 trillion US dollars. And if we only focus on the costs and benefits of phasing out coal over shorter time horizons, you get a smaller benefit. Up to 2050, it's around 18 trillion, up to 2030, around 1.7. And what we find, and that's the column above, the present value of the cost of climate finance are large, right? Over the course of this century, it's around 36 trillion, around which 29 is the actual renewable investment costs, and some smaller part is the complementary storage technologies and also the opportunity cost of coal. But the point is that the costs are small compared to the benefits of avoided climate damages, and even smaller if you would also include benefits from avoided air pollution. And the point is that a lot of these costs can be financed in principle by capital markets. So what we argue in the paper is that the provision of climate finance results in a coercion bargain that makes us all better off, and it's sound economic logic to not only compensate for the investment costs to build renewables in place of coal, but also to compensate for the opportunity cost of coal, which means that we don't only, as is now the conversation, compensate coal workers that lose their job and help them retrain, but actually under the coercion approach, it's sound economic logic to pay the polluter to stop polluting if that makes you better off, if it gives you a Pareto improving outcome, as you see it does. So we must actually pay coal owners, which sounds counterintuitive, to make them be in favor of keeping coal in the ground and retiring coal capacity early. So here we show what the climate finance needs in different regions are. You can see that most of the the climate financing needs are in emerging developing market economies, specifically in Asia, and we account for exports in the two different graphs. I'm not going to go into too much detail now. So the question is, how can we incentivize participation for climate finance? So as I said, so far, climate finance has been framed as the equitable thing to do, given the West's greater historical emissions and also greater wealth. But this has not got us very far in bringing climate finance to scale. So we argue that if you are able, and the other problem, of course, that you cannot strike a global deal. So what we argue is that actually you want to strike deals with one big coal polluting country at the time, adding up to a global deal. And so if you are able to offer finance for renewables conditional on the commitment to retire coal capacity early, such that you phase in renewables and phase out coal at the same time, you can make sure that the energy demand that existed for coal is swapped with renewables. So you can limit carbon leakage, even if you only focus on a climate finance deal with one country, which means that you no longer need a global deal, but you can add up country deals to work cumulatively towards the global deal. Now, what's the economic case for Western governments to finance emerging developing market climate finance deals? Well, if you are able to strike this deal which has a lasting emission reduction embedded in it, then you can look at the global social cost of carbon, which is an estimate of the global benefits resulting from each ton of emission reduction. So you can multiply the global social cost of carbon with the emission reduction, and you can look at what slice of the pie of that benefit is attributable to each country, where basically you need to have the country level social cost of carbon of each country to know what the benefits are for individual developed market economies of helping to achieve such an emission reduction. And we can show that the even conservatively estimated that the benefits in terms of avoided climate damage, for example, for Europe or for the US, are so much smaller than the amount of funding that they would need to put in to help, let's say, Indonesia reduce its emissions. So now, how do you bring investors on board? Because, of course, ideally, you don't want governments to pay all. So we argue, and this is more generally argued, that you want to make use of blended finance, where essentially the governments only put in the money, for example, in an asset-backed security in the first loss tranche to make it attractive for capital market participants to come in. And this is key because so far investors have not invested a lot in emerging market economies because the risk is too high compared to the return that they seek. So, there's a lot of talk about investors, wanting to do good, but the truth is that ultimately even ESG investors typically seek returns. So we must make sure that investing in a transition is simply good business for investors from a traditional perspective of risk return. Now, how do you bring coal communities on board? And this comes back to my point that it's sound economic logic to pay polluters to stop polluting. You want to make sure they are at least as well off as they would have otherwise been under business as usual. So you want to pay them for their stranded asset value, for their opportunity cost of coal, e.a. their missed free cash flows. And you want to pay the broader coal communities that are losing their job. And I'm in this, short presentation not going into all the details of the methodology, but we've estimated, for example, what the opportunity costs of coal are, and actually they are 2 magnitudes smaller in the billions compared to the for example, cost of investing in renewables, but also the benefits. So even if you would pay thrice as much to coal communities to get them on board, which is critical, right? For example, Joe mentioned in West Virginia would probably not agree to a phase out unless he got serious compensation. You must pay, and this is also successfully done, for example, in Germany by means of auctions. So as I have been discussing with my co-author, Jermin Zettelmeier, even if there is an economic case for the rich countries to finance emerging market climate finance deals, there may still be incentives to free ride. But if you can find a funding coalition of countries where the internal incentives to free ride do not exist, for example, the G7 or the G7 plus the EU, you can solve this collective action problem if the benefit of this conditional climate finance for the coalition in terms of avoided climate damages exceeds their financing costs. So here, Jermin made a table where we look at different coalitions of, on the columns you see the different funding coalitions, and on the rows you see the different recipient EMDE economies. And let's focus for now on the right row. Here we see the funding coalition of the EU, the US, Japan, Canada, and the UK. So they would, as a collective, like as we will get to the JET piece, provide funding. And for example, they would find, let me stand up for 1 second. They would, for example, provide this funding to India. And so what we find is that there's a net economic benefit of about $1.5 trillion US dollars to provide climate finance over the course of this century to bring India's coal emissions in line with net zero 2050 targets. So in principle, funding coalitions exist that are giving an economic benefit to the West. So there is an economic case, not just an equity case, for the West to pay money to developing market economy. So it's not giveaway, it's not just charitable, it is also self-interest. So our paper provides a novel economic case for foreign climate finance at scale. So of course there are various things that must be done. Part of the way in which these type of deals are struck is that typically you have a multilateral development bank that helps bring the public and the private funding together. So multilateral development banks must be reformed so that they, in their mission, have the objective to support low carbon development, that they go away from a business model of direct lending to becoming the catalytic lender of blended climate finance, and also that they go away from a business model of project-based finance to a business model of system-wide finance, or in other words, financing a country transition. And what we really need is a new ESG asset class, and there are now many ESG assets that actually don't help bring down emissions. And if you do this, create this blended finance asset class, you can actually create an asset class that helps bring down emissions, which is what we much need. So how is this idea implemented today in practice? And actually for us, this was a surprise that this was done, because we wrote our paper and then we figured that the JETPs are a perfect fit for our paper. So what we argue is that we must offer financing by developed countries to EMD economies, conditional for their to build out their renewables, conditional on their commitment to retire coal capacity early, and that this funding should be offered in a blended finance manner by the public and the private sector, and that it must be a just transition where somehow the opportunity costs of coal are compensated. And this is exactly how the JETP, specifically with Indonesia and Vietnam, have worked. So for example, in the Indonesian case, there was 20 billion offered, of which half by the public sector, specifically the G7 countries and the EU. The other half was offered by banks that signed up to the Glasgow Alliance for Net Zero. And this was offered to build out renewables, but to help Indonesia lower its interim 2030 target and bring a certain amount of coal capacity offline. And it's a just deal because indeed the opportunity costs of coal are compensated. So we can show in the paper, and I'm not showing the plot here, that there's a net economic benefit for the G7 and the EU to provide this funding. Now, of course, a big question is, are these JETP deals big enough? And so, for example, in the Indonesian case, 20 billion was provided, and you can see that here in the left column. But actually, the government estimates it needs about 150 billion, so it's less than the government estimate. And in our paper, we actually think that the estimate of what is needed is even bigger, depending on whether you account, how you account for how climate finance is allocated. And let me just say a few things about this. So there are 4 columns. This is if you also include climate financing needs, including storage, right, and grid extensions, and this is just for the renewables. And then there are 2 different columns. One is where you account for exports and one where you don't. And of course, the intuition is that if you are, let's say, as Australia, you're a big exporting country, you don't need as much climate finance. This is not a good example because it's a developed country, because the renewables must be built in the country where coal is consumed, right? That's where you need the power. So exports clearly matter, and we account for it. You can read our paper for more details. So what we argue is that if you are able to offer financing for renewables conditional on the commitment to phase out coal, such that you can limit carbon leakage when you strike a country-level deal, you no longer need a global deal to solve a global externality problem. You can actually strike country-level deals and replicate them with the biggest coal polluter to add up to a global deal. And this is very much similar to what actually Nordhaus is proposing in the carbon space with carbon clubs or climate clubs, where by putting a tax on the border for carbon or a pure tariff, you can incentivize a participation. And by the way, he uses very similar logic in terms of looking at economic benefits. And you can move ahead with climate mitigation policy without needing a global deal. So I'm going to skip this slide, but there's of course a question of, okay, how does the West fund this, and how does the recipient country deal with this in terms of debt sustainability? But let me conclude because I'm out of time. So our conclusions are sort of 5-fold, or at least the main conclusions. So to reach the Paris objectives, advanced countries will need to focus much more on creating incentives for EMD decarbonisation. Large-scale conditional climate finance in support of comprehensive country-level carbonization plans is in principle, as we show, in the interest of advanced countries, but the gap between principle and practice where the JETPs are large, and overcoming this gap may require a grand bargain involving higher-scale climate finance for higher ambition with appropriate monitoring and verification to make sure, of course, that once money is offered to keep coal in the grind, it's not later, dug up again and emitted, the emissions emitted. So, and we argue that if you can limit carbon leakage, which you can do if you do this replacement policy, because imagine again, if you just phase out coal in one country, coal goes up in another country and you haven't made any progress, so you must replace. Then you can replicate these JETP deals, let's say within India and with other big polluters to add up to a global deal. And that's much more feasible than trying to start, as we do again and again every year. And Nordhaus says, you know, COP has been a failure every year and it's not going to change, to add up towards a global deal. So what we believe, or at least certainly I believe, is that some of the most salient policy tools we have at hand for the gigaton challenge, and we must go from around 42 gigatons CO2 today to around 8 gigatons by 2030 to stay within the 1.5 degree budget, which is a very, very, I mean, unprecedented emission reduction. We probably must make use of non-global, incentive-compatible approaches where you can expand reach to add up to a global deal. And you know, to repeat William Nordhaus's words, he says, you know, climate finance is $1 trillion problem, and we better have a robust incentive structure. So what we do here is to try to explain how you can create a robust incentive structure for climate finance at scale. So indeed, what is the economic case for the developed world to support EMDE decarbonization? Thank you.
Thank you, Alyssa. The slide that you sort of skipped is actually quite important because, of course, the worry here is that while there is an economic case, we may not be able to afford it, right? So that the actual investment volumes that need to be financed are so enormous that they exceed the fiscal capacity of or even of the rich countries. And so this is maybe something we can come back to in the discussion. Now, in the meantime, let's go on to our main...
One thing to say here, we just missed it, but we did try to also look at how for different degrees of private sector leverage, right, you can get, or you can see it here, what the net benefit is for rich countries, it also depends on how much cost they put in, which depends on how much they can leverage private sector funding. So, of course, that's a way to try to lower the bill for governments. Back to you, Jeremy.
Right. Okay. So we go on to our fantastic discussants, and you know the reason why we invited them in part is because we have two that are really experts on the JETPs, that the Just Energy Transition Plans that were described by Alyssa, and the first particularly. Who knows this area particularly well is Abhishek Bhaskar, who leads the Climate Investment Fund's Accelerating Coal Transition Investment Program. So this is exactly on the subject that was touched on by the presentation. So go ahead, please, Abhishek.
Thanks. Thanks a lot. If you could give me a thumbs up that the audio is clear.
Very good.
All right. Awesome. Great. First of all, thank you for having me here. It's good to see some friends here. Good to see Lida here, who brings a wealth of experience working on this from the US side. So privileged to be on the same panel as her to talk about some of these issues. What I thought may be helpful is to share what we have been doing, where we come from, so that then when I provide some response, some feedback on the rest of the presentation and discussion, you can see the source or the experience at which it is anchored. So I lead the Accelerating Coal Transition, or the ACT investment program at Climate Investment Funds. The Climate Investment Funds are one of the oldest and largest climate funds in the world. We have, for over 15 years, deployed around over $11+ billion in funding capital in areas such as clean energy, resilience, forestry, and of late coal transition. So 2 years ago, we launched the ACT program, the coal transition program, at COP26 in Glasgow, where we sought to address the issue of coal transition in a very holistic fashion. And the way we went about it was to create this program that looked to tackle 3 key aspects of coal transition. One was to do with policy and institutional reforms, so setting the policies right in these coal-dependent economies, to making sure the coordination of the institutional structures are aligned and in place to implement the coal transition strategy. The second element was to do with just transition of the coal communities in these countries. And this included not just retraining, reskilling them, but also providing actual capex investment opportunities in the core regions, which are typically mono towns, mono industry towns, with not much else going on apart from the coal activity in question. So how do we diversify local economies? How do we create alternative livelihoods for these communities in a post-coal era is a core part of that second pillar around just transition. And finally, under the third pillar of infrastructure, we try to tackle the issues related to stranded assets. So how do we retire and repurpose existing coal mines, existing coal plants, and so on? So together, the package of policy and institutional reforms, just transition of communities and infrastructure, we thought addresses adequately some of these issues in facilitating a coal transition. So we launched a program with a funding envelope of a little over $2 billion that was dedicated to this program. And in order to deploy those, we banked on our business model, which was to offer funding at scale. And the kind of funding we offer is concessional finance, which is funding that comes with long tenors, low interest rates, in order to address each of these pillars in these countries. And we now have 6 countries under the program, which are India, Indonesia, South Africa, Philippines, and earlier this year we selected North Macedonia and Dominican Republic. Each of the first 4 batch of first 4 countries were allocated $500 million. So $500 million in concessional resources are capable of mobilizing up to $3-4 billion. So if you look at scale, then $3.5-4.5 billion to address coal transition in that 3-pillared approach in each of these 4 countries. And then we had funding available to support these 2 new countries with 85 million in concessional resources. And again, if you do the co-financing mobilized, then it amounts to significant amounts, especially in the context of an economy like North Macedonia and Dominican Republic. So that's what we offer. One key aspect of how we deploy these funds, which is relevant to this discussion, is that we follow a programmatic approach, which is essentially we work with countries who lead the development of an investment plan, which is a more sort of a comprehensive assessment of their coal transition ambition and an explanation of how our funding would go into support what they seek to achieve through their NDC strategies, through their coal phase-out commitments, and so on. So because of the nature of the ACT program, it aligned very well with the JETPs, and we were engaged deeply with the first JETP that was announced for South Africa 2 years ago. And then we are going to play an important role in Indonesia as well, again, by the virtue of that alignment of what we are seeking to do and what the JETP is seeking to achieve. And so that catalytic nature of the program is helping drive some of that ambition under JETPs. Now, on the JETPs itself, I think there are a couple of things that we could share in terms of potential considerations, lessons, what we think has worked or can be improved upon. I would say in 2 or 3 buckets. In terms of principles, I would say there are a couple of considerations to bear in mind. One is that a JETP process, which is a country-driven process, must be led by a country if we want the outcomes to be sustainable. We cannot impose it. There is a multiplicity of actors and stakeholders at the country level, and so it is the country that must drive that effort. It is important to understand what is the additionality of both that ambition, that it is beyond what a country would have achieved or gone for, as well as in terms of financing, in terms of what is the additional resources that has been mobilized as a result of this delta commitment by the country. So I think additionality of ambition and financing is important. On the financing side, I think what is crucial is how do we mobilize the right scale of financing and how do we mobilize the right type of financing? Alyssa mentioned a JETP gap of funding. And in my view, countries need not mobilize, cannot mobilize the entire JETP demand of what a country seeks to achieve. What a JETP is it is a down payment of sorts. It's a catalytic fire starter of sorts to get the country on a pathway such that this down payment, this catalytic financing can help attract private sector and help bridge that gap. So that's how I look at JETP, and not necessarily in terms of a JETP gap, that the entire volume of funding must come from the global north, for example. I think that brings the point around the role of catalytic investment and programs, and how important it is to get some of these country level interventions start. And Alice already touched on the need for a sound implementation strategy and so on. With that, I will reserve the last 1.5 minutes for some reflections on the presentations, as was requested. Very rich, I think, in principle. The idea of having an economic justification to support the global south is a sound one. I think we are way beyond, especially if you look at growing economies of India, Indonesia, we are way beyond the idea of an aid structure where money flows from north to south to help them achieve certain goals. Some of these countries are sound enough, the demand and the access to resources is significant enough to drive their own ambition in a way that they deem fit. So I think that's very well taken. However, I want to make a couple of points on some of the flaws of climate finance architecture and those as they were presented. And I would start with COP. I just returned a few days ago, so maybe part of it is a bias from that trip. But I think I would not discount them, or I would not look at it in a binary fashion that you need one or the other. I think over the years, if we pick up from 1995, when UNFCCC was launched, in 97 we approved the Kyoto Protocol, and that was the first time when the idea of common but differentiated responsibility came to fore. And there was the first time when we saw targets for global north. That was the first time when we saw a government response to a policy environment that can facilitate more renewables come in, take shape. That was the first time when private sector started to look at it more carefully in terms of what is the additionality, what is carbon revenue, what is carbon finance, what is GHG reduction. So I think that had an impact that has informed subsequent generations of climate finance flows. If you look at 2009 Copenhagen Accord, that was the first time $100 billion pledge was sort of put on paper for a number, a specific number. And you can go on, you can look at Paris, you look at the 1.5-degree target, you look at Glasgow Act to 2021, you have NDC review and so on, and fossil fuel phase out. All this to say that I think there is merit. We need not look at it in a binary manner that whether they have failed or not, or they are a flaw or not. I think a lot of those global deals or global meetings or these COPs have driven local action. We need to look at it in a more evolutionary, with an evolutionary scale lens, I think, in how they have informed subsequent phases and actions or under climate finance and so on. Final point, I think I also, in the same spirit of not using a binary lens, suggest that it's not a matter of phasing out fossil fuel versus scaling up renewables. It's both. And the rationale in the paper of we are running against time is a sound one. But I would not, again, look at it that we don't need we need to phase it out. We need both. And I think that's important. But again, very well taken, good points around the economic justification and so on. I think my time is up, so I'll stop here. I would be happy to come in later. Thanks. Back to you.
Great. Thank you so much, Abhishek. And now we have Lida Fitz. Go ahead, please. You have also worked on JETPs, although from a completely different perspective, I believe. And that's maybe I mispronounce your first name. How do you say
that's
it?
Fine. It's Lida.
Lida.
I'm Lida.
Okay, Lida Fitz.
And I am the director for our Sustainable Infrastructure Office at the U.S. Treasury. And my office has the has the honor of leading on the Indonesia JETP for the US on implementation and from the initial negotiation, and worked with Abby very closely, particularly on the development of the South Africa JETP and early implementation. So pleased to hear his description of the overall structure and challenges. I couldn't agree more. I'll save those moments from my remarks, and just say that we really appreciated looking at the paper. I think that you make some really compelling arguments. We would agree that there is a very compelling argument to focus on single countries. That is indeed why the JETPs were designed to focus on high emitters. There's so many competing potential uses for climate finance, but we see looking and partnering with high emitting countries from a coal perspective as very much a shared benefit endeavor. Yes, there's an equity angle, but I think that it's clear across the IPG partners that these countries, their emissions and their energy transition is something that we globally will gain from their success. So very much appreciate the validation of a single country approach in that partnership. And I think that the importance of bringing in the private sector, as you saw and noted in the Indonesia and Vietnam JETP, is also essential. It was no surprise to see the implementation plans come out of South Africa and Indonesia with price tags estimated for their transition much, much higher than the $8.5 or $20 billion that was put together as a package for the initial joint statements in both countries. However, there was always an assumption that the transition would be much, much larger. And I'd say that there are two things to note there. And one is that those overall totals at the beginning are not static. We do anticipate and have partnered with countries to have them anticipate that the public side of those funds would grow over time. And indeed, in South Africa at COP this year, you may have heard that from that 8.5 initial, the public's commitment is now up over 11 billion just in the last couple of years. So there is an ongoing, it's not a single pledge at the beginning, but an ongoing pledge to work through with countries to try and mobilize additional public funding, as difficult as that is. And on the private side, that is really where the potential for scale is. And as Abhishek said, like aligning the policies and the market factors in these JETP countries to allow private sector to come in and scale is really the secret sauce that will enable these to succeed. So I think in Indonesia and Vietnam, of beginning that partnership with the private sector, fully aligned and arm, was this next generation of the JETPs to make sure that we can actually get to the scale over time, and that we have large financiers who have a similar commitment to doing that. And we've actually seen their approach to bankability, their appetite in these markets to have significantly shifted to be more forward-leaning. Still definitely will need a return for their own fiduciary duty, but the risk that they're willing to take, I think we have seen a step change there. And then I'd say that another advantage of JETPs is to try and pilot out some of the blended finance approaches that your paper recommends that we take up. Blended finance is not new, but I think we have new players and we have new potential volumes. We've noticed a number of blended finance platforms announced at COP, including the US's announcement for blended finance for energy transition, which is specifically targeted to JETP countries that provides, first loss catalytic money from the public side to add extra push on the private. I think that when we talk about money, I would also say that on the just side, it's been an early lesson learned that the funds that are designated for job retraining or job replacement for coal workers and it's in too narrow a view for just. Not only to your point is that the coal mine owners and the coal plant owners need payment, but so does the entire surrounding community, the restaurant owners that service those plants and the transportation companies. I mean, it's a much wider set, and this is really playing out in South Africa, where unemployment is already so high that any shift in that makes an immediate hit. So I think that larger view, and for that matter, when you start to, none of the energy transition costs across these JETPs envision a payment to coal mine owners, and certainly in Indonesia, that would be a significant shift in terms of the production of coal versus the production of coal power. I would say that one I appreciated in your approach, that you're also looking at the art of the possible. Let's not continue to focus on one grand bargain. Let's not continue to focus on one global carbon taxation deal, as ideal as that might be. I'd say that lesson also raises itself in country platforms. As the U.S. has a Joe Manchin, Indonesia has many, and South Africa the same. And so we really have to look at what is, not just the economic case overall, but indeed what the economic case is on a narrower level, and how do we align interests to make these shifts politically possible on the ground. Our Indonesia lead on JETPs said that he views these as like having a personal trainer, and the IPG and the partnership both make Indonesia look at itself and what it needs to do hard and to work hard to make that. I will say that he does always point out that you expect your personal trainer to be in better shape than you, and so I would highlight that I think that there is an important, not just economic play, but political play in the domestic investments that countries are making. Particularly, I can speak to the IRA in the U.S., where in having these conversations, it's important that we're making efforts to put our own house in order. And of course, the U.S. it remains a major polluter. So being able to demonstrate your willingness to invest in your own transition, I think is key to being a partner that others can trust. And it also helps to demonstrate, we believe it will be demonstrating, and already is demonstrating, that the energy transition can pay political and economic benefits immediately in your country in terms of job creation. And so proving that out in our own market has been helpful for us in discussing with countries, taking on the very hard political work of shifting an economy from coal to renewables. Understood the grand picture being that renewables are going to be more competitive and a better economic solution. But the transition is uneven in that regard. And so looking at the U.S.'s ability to create those economic returns has been helpful in giving confidence to many of our partners. Similarly, on the renewable side, it is more than a single. It's more than having experts come in and demonstrate or explain how you could shift your grid to renewables. There is a very much a political imperative on energy security. And so while the JETPs are designed, and we are the ACT is a core piece of each one of these, as Abhishek noted, to focus on the removal of fossil fuels along with the expansion of renewables. I honestly think that in each of these countries, we are going to see the actual implementation focus a little heavier on the expansion of renewables first, because it is just a politically more palatable approach to make sure that everyone understands that there is full energy security, that there is a way to bring renewables onto the grid, of managing the variability. The concerns vary per country, but it is not, even with the funds on offer, there's hesitance at a utility owner and municipal leaders to feel like they are a guinea pig in this. So I think that we'll continue to see a build out of renewables come at a minimum of alongside, but a little bit in advance. And then that's just a political reality. And then I'd say that the other thing that your paper doesn't necessarily touch on that I would add here, and then I'll finish, is that developed economies have a role in creating demand. One of the most effective movers that we have seen in terms of communicating the political and economic imperative to countries to making this transition is actually both the work that Europe is doing with CBAM and the discussions that large corporates are having in FDI discussions in these countries of, I will come in and I'll create X number of jobs, but I have to meet my own net zero goals, and thus I need a clean energy supply chain to locate here. So those direct, immediate demand signals that are helping to be created by developed economy policies and incentives are also a key part of demonstrating that these transitions will not be a payoff that you expect in many years, but that you will start to be able to see immediately. Over.
Thank you. Very, very nice points, Leida. Now we turn to Li Zhao. Hi. Very nice to have you here. So Li is the Vice President of the Boao Forum and works mostly on international finance and sustainable development issues. And before that, she was the Deputy Director General of the International Department of the People's Bank of China. Floor is yours.
Thank you, Jerome. Many thanks for including me on board. And I really enjoyed the points raised by the three speakers. I would like to spend the 8 minutes to share with you the key messages sent out by our latestly launched report on the side of COP28. So the report's name is Net Zeroing based on incentive mechanisms and carbon markets. And actually, just now I heard several times of incentives from the three speakers. So, okay, let me kick off the slide. Sorry. Here it is. Okay. Yes. And so, and I don't want to spend too much time on mentioning the big gaps in climate ambition and climate finance. And the IMF just presented 2 charts to show the gap in climate ambition and also the gaps in investment gap for emerging economies. And just for the emerging economies, they mentioned that to reach the net zero, the global net zero 2050 scenario, and the investment for emerging market, private investment for emerging market, need to increase from the current 40% up to 90%. So that's a big jump. So and also this does not account China. And for China itself, by 2060, we need around like 20 trillion US dollars investment in mitigation. Okay. So next. So the key message in our report is trying to answer a question. So well, what is the appropriate pathway we need to choose by self-awareness, by state planning, or by market? So the message and our answer is a pathway based on market incentive mechanisms and driven by the market need to be chosen, supplemented by self-awareness and state planning. We chose a major sector to elaborate. That is the power sector. So the power sector, is the top priority of major countries' decarbonization. So globally, on average, the emission in this sector account for around 45%. And for G20 economies, we have a chart here. So like for China, Indonesia, and the emission ratio account for over 40%. And for the other 8 countries plus EU, and the ratio is between 30% to 40%. So that means this sector should be paid great attention. And for IEA, on the right-hand side, the IEA 1.5 degree scenario, they forecast that the electricity sector, the emission in this sector needs to go neutral before or by 2040. So that means we need to pay great attention in this sector, and including new and renewable energy generation, and also reserve capacity and energy storage. So in this sector, the correct price signals is very important. And I just would like to give you some examples in China. And in China, before 2021, the investment in pumped hydropower station was very small. But in 2021, and the government put in place a new policies to on the pumped power reserve capacity compensation. So that policy drove a tremendous investment in this sector. So in 2022, last year, more than 200 pumped storage power station projects got approved, exceeding the total scale for the 14th five-year plan. So this is a good example. And also now China is undertaking the reform on electricity price on the demand side. So and also we need to gradually phase out subsidies to electricity generation. So this is a very important, very correct price signals to boost investment. And also this table is an interesting table we made. And from this, you can see we had this feed-in tariff and policy in China for solar energy, so for solar power and also for wind power. So they have different policy year. And then we also have the comparable shadow carbon price for these feed-in tariff. So you can see how quickly those power builders or power firms, they got incentivized by these shadow carbon price. And then turning to carbon markets and their role to play. And I have two charts from the World Bank, and I think Abhishek should be very familiar with this one. So on the left, we can see by 2022, and only around like 23% of GHG emissions were covered by our carbon price. So including the carbon taxation and also ETS. And then we can see that up to 77% of the GHG emissions were not covered by any carbon price. And for 10% of the emissions were covered or were charged by less than $10 US. And on the right-hand side, and also from the World Bank statistics, we can see out of the 23% emission coverage, and 18.4% were covered by ETS. So that's emissions trading system. And then from our observation, we pointed out we highlighted several issues. The first one is to enhance or to strengthen the carbon markets. Attentions ought to be paid to issues such as the cap of the total allowances and the extent of free allocation of allowances. That this will tremendously have impact the price and the revenues of the government. And then the interactions of carbon markets and also dynamic characteristics of carbon prices. Why we mentioned about the dynamics characteristics, that means once a new technology emerges and the carbon price may quickly dropped down. And the second point is on how to avoid greenwashing. And this is a key issue. And has been continually debated by international community. So we think that if the carbon credits, the price of the carbon credits is too low, then it is whatever it is with high integrity, with high quality, those people who buy them will get blamed. Since the cost for them to cut emission is so high, but it's so easy for them to buy low-priced carbon credits, right? So the solution is to have a interaction of carbon markets and to help the price converge. Then in the long run, and the greenwashing problem will be tackled with. So the third point we would like to mention is on just transition. We also think controllable connections between global carbon markets should be considered, allowing investors in developed countries to purchase carbon allowances and carbon credits from outside markets. So this is the most efficient way for the private sector, especially in the advanced economies, to pour money into developing countries. And the future CBAM revenues should be recycled to the carbon markets of developing countries. So this is our observation. And I also have several charts. So given time constraint, I will not go through them. So lastly, we also made a study on the new green technology and also the cost of these technology. And for now, like for example, for China CCUS, now the current cost for them is to capture per ton of CO2. It may cost 140 to 700 yuan, so amounting to equivalent to 20 to 100 US dollars. So we have some very in-depth analysis across the new technology. So the conclusion is that establishing incentive mechanisms through carbon markets and carbon pricing is an important pathway to address the significant financing gap and promote technology advancements. So I will stop here. Thank you.
Thank you so much. So we are going to go to the audience now with questions. And so I would like to invite questions. Now, maybe to help kick this off, I'm going to sort of add my one question for each of the panelists just to the pool. So maybe well, we have a whole bunch of questions. So let me actually just focus on 3 points for our guests. So maybe for Abhishek, on the climate investment funds ACT program. So you said, particularly at the end, that what is really quite key is this complementarity between renewables investment and phasing out of coal. But as I understand it, the Accelerating Coal Transition Investment Program focuses on the phase out, right? And so basically I was wondering how this hangs together, and also generally, the fact that you seem to operate in countries where there are no JETPs yet, and so in a way you precede the JETPs. You also precede this sort of ambitious approach of trying to, blend, a form of conditionality with finance, with trying to pursue the phase out and renewables investment at the same time, and so how does that work, for example, in a country like India? And maybe for Leida, my question would be, where do you see the constraints to scaling up JETPs? So is this a problem of availability of financing? Or is this a problem of implementation capacity, political economy problems in the implementing countries? Of course, to some extent, the idea is that, financing helps overcome those problems, because to the extent that you compensate, say, the affected coal communities for the opportunity cost of losing their normal livelihoods, that would presumably feed into the politics. But there's maybe also a side to political difficulties that, in a sense, money cannot overcome. So can you talk about this? And then to the extent that money is the constraint, and like you said, the fractions that the money that has been committed now by the donor community is really a very small fraction of what those countries themselves think is necessary. What is the barrier to bigger financial commitments? Is it a public finance constraint on the side of the donors, or is it sort of a sense that we are in the rich countries not completely sure that if we were to, say, go ahead and borrow another 10% of GDP or 50% of GDP, which many of our countries could, to decarbonize EMDEs, that we would actually get our money's worth, right? So does it have to do with this constraints in verification? And then maybe one question for Lee. So you spoke about carbon markets at the very end, and indeed we are seeing them emerge. China has an emissions trading system, but the prices are quite low at this point. So can you maybe say something about what it would take to raise prices to something that we think of as being closer to the actual cost, the social cost, the opportunity, the social cost of carbon emissions? So those are my three, and from anyone from the live audience, please go ahead and identify yourself when you get the microphone.
Hi, thanks a lot for your presentation. My name is Friedrich Lucke from the Joint Research Center. I would like to ask a little bit about the political economy in particular, because I have two examples in mind where it seemed to be very difficult to convince developing countries to accept the money that they were being offered. One case was in Brazil, which has been offered quite a lot of money to protect their rainforests, which has been shown to be one of the most cost-efficient ways to abate carbon emissions. But Jair Bolsonaro basically rejected this and was much more interested in developing his forestry industry rather than receiving money to protect the forests. The second example is from the negotiations of the G7 or G20 with Western African states, where the Western African states were much more interested in receiving technological and financial aid to develop their own natural gas capacities rather than to build up their infrastructure of renewable energies. Now, we can speculate on what these reasons are that the countries were not so keen on complying with the agenda of the G20 or the EU. Perhaps it has to do with the fact that if you have natural gas resources and as a state you to develop them, a lot of money will be flowing directly into the government's pockets, and the ones in power can do with that more or less whatever they want to. But I see a big challenge, and I have not fully understood what is the incentive structure to ensure that the developing countries and their governing elites will actually have the incentives to accept the climate financing that we could offer them. Thank you.
Okay, so that's an important point, I think, for Alyssa, but also for any other of the other panelists. Yes? I suggest that you pool this with your comments, right? Because we're running out of time. We only have about 6 minutes left. Maybe when you do this, can you also just take 2 points from Slido? If you could, there was a factual question: what is the social cost of carbon per ton behind the calculations? And then there was a critical remark, I would say, from one of the online audience member. The point is not the economic benefit, but the intertemporal and geographical distribution, right? So I think, I have a feeling you're trying to address this point, but maybe you can say how this works. Finally, my colleague Heather Grabby, who is a senior fellow at Bruegel, but unfortunately is not here in person, but she's online, asked, but is the aid model that Abhishek said is no longer suitable for India and Indonesia, how would one create incentives for coal phase out in those countries? I guess the Indonesia part of the question is partly answered by the JETP idea, but India does not have a JETP. Abhishek, maybe you can sort of include that in your answers. So let's go now in this same order. Alyssa, start. I know you have a lot to say, but we only have a few minutes left, so be brief.
I'll be very short. So thank you so much to the three speakers that gave very insightful thoughts and also feedback. So let me very quickly say, of course, COP has value, but I think it's dangerous if we only tie our hope to COP, because it will tend to focus emphasis on the need that ultimately COP, if it is useful in that way, needs to spur these more local actions that where the real bang for buck in terms of emission reductions will come from. I really liked Lida's comments. Specifically, she said that there's sort of an understanding among developed economies that they will colloquially benefit from it. And I think it's important to realize, though, that if we only build out renewables, then there will be a smaller benefit for developed countries, because the benefit really comes from the emission reductions embedded in these deals, which are also largely driven by bringing coal offline. And I know there are political difficulties with that, but that's why I think it's important that you compensate, as you say, the broader communities beyond just the coal owners and the workers, but indeed the regional communities that are in place. So I just want to sort of emphasize that for a developed country, you can actually compute what your benefit is, right, by looking at the emission reductions embedded, and then how much of the total cost you must finance given the catalytic ability that you have. And that it's important to do conditionality to avoid carbon leakage. As Abhishek said, and then I will turn to the questions of the audience, there is indeed, a funding gap, right? But Abhishek said the hope is that the public funds can catalyze more private funds in the future. But of course, so far that hasn't happened, right? So for Indonesia, it's half-half. And so our gap calculations are gap calculations for total funding gap, no matter which part is funded by the government or by the private sector. So to your question, I'm not familiar with the details of these specific examples, but I would think that perhaps the reason why Brazil decides to invest in its forestry practices rather than in accepting the money of protecting the rainforest is that they've done a cost-benefit calculation, and they figure that their benefits are bigger, economic benefits from selling forests and tree trunks, than from protecting the rainforest. So if rich countries would perhaps up the funding for protecting the rainforest such that it's more, then they would have gotten for selling their cutting their forests, they might have accepted it. And likewise, for Western African countries, perhaps their calculations are that their natural gas investments will offer more money than the money they get from building out renewables. So then on the question of the geographical distribution of and intertemporal distribution of the benefits, so this is exactly why we, in the paper, move away from looking at the global net economic benefit of phasing out coal and replacing it with renewables to looking at the country-specific costs and benefits. And so if you want to know what the benefit is for, let's say, America of helping to finance an EMD deal, you specifically want to look at the America's country-level social cost of carbon to understand from sort of given how climate damages are expected to be distributed, how much benefit America would gain from avoided climate damages. Of course, there's also an intertemporal dimension. So we do the calculations in a net present value manner, and that's more difficult to solve. But what I guess makes sense is if you know that some of the benefits will come in the future, you might want to offer as or issue as a rich country government bonds so that part of the cost of paying for the benefits that come in the future are also borne by future generations that have to pay back these bonds. So with that, I will.
Thank you. Bhaskar, can you try and reply in less than 2 minutes?
I'll take a minute and a half. Real quick, coal phase out versus renewable energy. See, today in many markets, most markets, renewable energy is commercial. So you don't need concessional or public finance to support renewable energy. Private sector can come in and support that. But you may still need funding, whether it is concessional or public, to support newer technologies such as storage that facilitate integration of more renewables. ACT program, what it's trying to do is to focus on a very particular aspect of energy transition, which is to do with coal phase out, because there are not many initiatives that do that, especially in these countries. I'll tie the question 2 and 3 on economy, on India and so on. So it's a real question for me, because when I go and talk to government of India, then I have to make a case for why and how to use these funds. And I think it's pretty straightforward. Even if we take the whole $2.5 billion pot that we have for ACT and offer it to India, which can mobilize, let's say, 10 billion in total, that won't be enough for them to, or for anyone to claim that we have been able to move the dial on coal in the country. But what we are saying, and what we have been saying, is that this is an opportunity for them to test out potential models, potential approaches, modalities that include people, that include policies, that include institutional reforms, that include, above all, the stranded assets side of things in terms of cost. And so you can try out what can work, what may not work, so that once the inevitability of coal phase out becomes real, comes closer home, then you are ready with what has worked, what may work in those aspects. So that's how we would approach it. I would suggest for big economies such as India, because the scale of resources that's needed, I think it will be impossible almost to put for any global north or a group of north countries in any single country. I'll rest it on that. Back to you. Thank you.
Thank you, Abhishek. Lida?
I'll be brief, but I'll say that the challenge to scaling JETPs is from a number of angles, and certainly finance is part of it in terms of scarce public dollars and the competition of those dollars for other development needs. And we have made a choice to partner with high emitters, but these are middle income countries. So the justification for spending there and not using dollars on hunger and health core global goods in developing countries is one that we have to be able to justify. I think that there's also an element of just human capital scale, the amount of coordination across IPG and governments, partner governments and philanthropies and private sector to pull these pieces together is enormous. And really only makes sense as a spend of human capital in these high emitters. So sometimes we've gotten a question of how many other countries could do JETPs, and I don't think that the model is built well for many others. But I would say that there's also a real challenge. These are very complicated when you get down in the weeds. And so, for instance, in Indonesia, they really are interested in building out their piece of it being a clean energy supply chain with provision of nickel. But that provision of nickel is coming out of mines, in off-grid locations where there are not clearly viable technical alternatives to coal. And so we also have to work closely with what's with a push-pull of economic growth that is in overall clean energy interest, as well as a push to make sure that growth is a fully clean supply chain. Over.
Thank you so much, Lida. And last but not least, Lee.
Okay, for Jeremy, for your question on carbon markets and carbon price in China. And I think now we still have a very limited coverage of this market. It's only for electricity and related power suppliers. So and now our Ministry of Environment, and they are trying to expand the coverage, including like in cement and steel and the other sectors. So this will make other sectors which need to transform, need to decarbonize to compete to bid in this market, right? So the second is now the market is still an intensity-based market. It's not a quantity based market and no cap for the allowances yet. So this is also another way to move forward. And actually, and now according to a statement by one of the officials, now the carbon nationwide ETS in China, the price is almost equivalent to those in the market of Korea and also in California ETS. So that's for your information. And for the last question about the ownership of the developing economies and emerging economies, and I think they definitely need to have several pillars to help them absorb climate finance, the policy environment, and the capacity building and technology distribution, and also the project pipelines. So I just would like to mention these factors. Thank you.
Super. So we didn't run so much over time. Lee, Leida, Abhishek, and Alyssa, thank you very much.